You really enjoy the first episode about the tier list of companies that you propose in comment. So in this video, we're going to continue this with so many other companies that you proposed in the comment section of my last video. So we'll rank them from the most quality, the best of best quality business to the worst quality of. So S tier will be really good quality company. A, it will be good. B, it will be good, okay, good. C will be just okay, bad, and D will be very bad. Okay, so let's go with the first one. It will be John Deere. John Deere, I never studied this business, Deere and company. So this company, let's have a look at some financials. How did it grow for the last 10 years? It grew by 8% per year for the revenue, which is fine. For the last 20 years, it grew by 4.8%, and the last 30 years, 5%. This is not really nice. Let's see for the net income, how did it grow? 21% per year for the last 10 years for the net income. Okay, and a bit decrease in 2024. For the last 20 years, it 8% per year, 30 year, 8%. So the margin were probably kind of a bit better, but let's see operating margin. They increased to 21%. This is something nice, okay? The main things that I'm looking at when it comes to analysis of those company, it's mostly about margins, okay? How did the margin of the company evolve, okay? The operating margin, the gross profit margin. The gross profit margin a bit less, but we want to see margin growing, okay? This is a good criteria for a quality company. We want to see as well operating margin growing is what we see here. We have an operating margin that 10 years ago was 9%. Now it's 21%. So it's something pretty good. Let's have a look at some ratio here. So operating and gross profit we saw. Net profit margin, it grew. The last 5 years decreased a little, okay, but still fine. Capital efficiency. Return on equity over 20%, so it's good. Return on capital employed around 14%, it's fine. Let's see if I can have the return on capital invested. This one is a bit low. With the return on asset, it's a bit low. Let's have a look at the debt. So debt to EBITDA 4.3, it's a bit high to be honest. Interest coverage as well is a bit low. We would like an interest coverage higher than 10, here at 3. It's low. Quick ratio, same, over 150, it's start to be a bit high. And debt to equity 288%. As well, it's a bit high for companies that didn't grow that much, okay? The revenue like this, for the future it's expected to grow revenue for until 2028, for the next 3 years, 0.27%, 4.3% for the EPS. Do they do buybacks? Let's have a look at this. Did they do some buybacks? Yeah, they do 1.65% per year since the last 10 years. So it's pretty good. I will put it at, yeah, it's a okay company plus. Like it's not amazing, you don't have a big growth here, but they're fine. Like they just have a bit of a debt, okay? So they are fine plus, they could be worse. It depends how important for you is the debt, okay? If the debt is very important, it will go C. If the debt is okay, because it's not that it's extremely high, it's just not optimal, it could be way better. So if they had a ratio under 3, maybe it would be B plus. It's between B and C, okay? It should be in the middle. So we are starting, so B, let's be positive with this and put it in B. We'll see after with other companies that we'll analyze. If we compare with them, maybe it will go down to C. But John Deere is between D and C. Uber Technologies, let's have a look. So Uber, what was the growth of this company? Okay, the revenue grew by 40% for the last 5 years, 17, expected to grow 13. The EPS, big growth, expecting to grow 5.8%. I think it's a bit low, the expectation for this company. Let's have a look. They probably do some dilution. Let's see the gross profit margin. It's decreasing. Operating margin, let's have a look. Operating margin started to be positive only in 2023. I guess they expect it to continue to grow because the net income probably started to be positive only in 2023. Remember that I think this year, 2024, they had an exceptional net income because of some acquisition, or not acquisition, but some profit, profit from an investment. They didn't sell, but they have some profit from this. The share outstanding, of course, they get higher. So the company is a bit too new. Because the company is kind of new, not new, but profitable since less than 5 to 10 years, it's a bit more difficult. Let's have a look at the debt situation. Debt to EBITDA is 0.82, equity here, interest coverage 7. Could be a bit higher, but it's still fine. So efficiency, return on invested capital 16, return on equity 45, return on capital employed 7. A return on assets, this is pretty good. A capex to operating cash flow, this is fine as well. Stock-based compensation 26%. So this is a bit high, but it's normal. They are not profitable since a long time ago. Let's see, how is it with the free cash flow? Free cash flow started to be positive in 2022. Since then, it's growing kind of fast. So yeah, this Uber is fine. Okay, it's not my favorite company. I will put it in A because it's definitely better than John Deere. I put it in A, but for me, it's not a company that I will consider in my portfolio right now because they are profitable for too short term. Like it's not they don't have enough of a profitability history for me to invest, but it still seems to be a good business with good margins, so it has some potential. Schlumberger, I have no idea what is this company. Schlumberger Limited, what do they do? Schlumberger provide technology for the energy industry worldwide. The company operates with 4 divisions: digital integration, reservoir performance. Okay, let's have a look at the growth. 0.25 in the last 10 years. Okay, so we don't really have a big growth perspective here. We don't really like it. Debt to EBITDA is low, interest coverage is good, equity is good. Okay, it's fine. The margin, gross profit 20%, operating margin 17%. Like it's very close. Gross profit margin and operating margin are very close, and free cash flow margin 12%. It's fine. They're good. The margins are kind of fine. Okay, efficiency. Yeah, here it's same. It's a bit low. It's okay. It's not bad, but it's not really good in the sense that 13% is a bit low, 21% is good, 17%. They are in a good part. Capex to operating cash flow, this is high. Over 20%, this is high. Yep. Stock-based compensation, 7%. It's good. It's under 10%. So, capex to operating cash flow is decreasing, so this can be fine. Let's see how the free cash flow evolved for the last few years. Okay, let's compare capital expenditure with operating cash flow to have a look how it goes. Okay, 2 out of 6, so it's 2/3. Yeah, so it's all the time like this. It's all the time like this, so it seems a bit difficult for this company to have a better operating. So this one, same. They have some good numbers. Okay, the growth is fine. The only problem I see here is the growth seems to be very slow. Okay, it's not a company growing very fast. For the last 5 years, it was kind of good, but for the last 10 years, for the revenue, it was a bit slow. Okay, let's have a look at the share outstanding. You seem to have more share every year. Okay, this I don't really like. This. Let's have a look how the net income evolves. I'll go search here. We had 2019, 2020. Why it was like this? why it got down like this. Here, total revenue, why it's not flat. Okay, it's very cyclical. It seems to be a very cyclical business. So this look more like, if someone is interested in this company, it look more like a value bet more than a long-term compounder. So for this reason, I put it in B. Okay, it could even go in C, but yeah, the numbers are a bit better than Deere because they have way less debt. So this is something good. I put them a bit higher than Deere. So maybe we'll put Deere here, John Deere here. But the problem is, I don't like the fact that they are very cyclical. So yeah, it's difficult. It's very difficult for this one. Microchip. I think they report Microchip. I don't know. Microchip technology. Let's have a look. So growth 15% per year for the last 10 years, 16. They have a negative growth estimate here. I don't really like this. Yeah, it's semiconductor, I guess. Okay, let's have a look at the debt. Debt to EBITDA, not really good. Interest coverage, not really good. We want this higher than 10. This under 3. Okay, even sometime under 2. Not really good. Margins, gross profit is good. Operating is good and is getting higher. Okay, free cash flow margin is good and getting higher. Efficiency, return on invested capital, okay, all of this is good, is higher than 15%, so it's pretty fine. Stock-based compensation to free cash flow, good. CapEx, it's good. Okay, let's have a look at the buybacks. They dilute the shareholders. This I don't like. I don't like that they dilute the shareholder. I don't really like the debt that they have. Let's have a look fast at the free cash flow. Free cash flow is growing good, like, okay, it seemed to be a good compounder. For the last 20 years, 11% per year. For the last 10 years, 19%. 5 years, 12%. So this is pretty good. This is pretty okay. The revenue should be the same way, yeah, for the last 30 years. So yeah, the only problem here is the debt, okay? For me, debt is, because of this debt thing, I cannot put it in high quality business because the debt is too high. The debt need to be lower because S is extremely great quality, A is high quality, B it's okay, like it's not bad, but it's okay. Here it's this. For me, it's okay. It's not bad. It's just okay because these debt levels are very high. Let's have a look how the debt has moved for the last years, especially the long-term debt. So it was very high, it decreased. Yeah, they increased it a lot here. Now they are decreasing it, so it's good, especially if they continue to decrease it, okay? For the last 5 years, it grew by 9% per year. For the last 5 years, sorry, it decreased by 13% per year, so this is good. Yeah, I will keep it at B, okay? Because for now, the debt levels are a bit high. First Solar, let's have a look at this one. Okay, so a photovoltaic, yeah, market cap 13 billion. Let's see the growth. Growth is very slow for the last 10 years, but lately the growth got better. They have some good estimate for the future. This is nice. Let's have a look at debt. They have no debt. This is very nice. Margins, a high margin, just the free cash flow, which is low. Let's have a look at capital. Okay, so stock-based compensation compared to free cash flow, it's negative because the free cash flow seems to be negative. CapEx to operating cash flow, okay, they have a lot of capital expenditure. We'll have a look at this. Let's have a look at the capital expenditure. Yeah. It's, okay. Operating cash flow, yeah, the capital expenditure compared to operating cash flow has always been way higher. I will put in LTM. Yeah, they always have capital expenditure way higher than operating cash flow. So this, for me, this is a red flag. This is a red flag. I really don't like this. So it's a bit tricky. It can be a trap. Let's have a look if they do some buybacks. Not really. Okay, they don't much first slide go here. They have good debt level, the margin and so on seems to be very good, okay, but this, let's have a look, yeah, it's a bit cyclical as well, okay. You see what happened in 2015, then increase. It seemed to be a bit cyclical as well, so yeah, it will go here. The debt level is fine, but way too much capex. It seems to be way too difficult to bet on this, okay. Too difficult to manage with this kind of capex, so no risk for myself. I put it in C. To be honest, the only company I would be interested in investing are companies that will be in S or A, okay. All under, for me, it's nonsense to try to invest and so on. I don't want to take this kind of risk. L'Oréal, a French company. Let's have a look. The growth, 6% per year, 8%, okay, for the last 10 years. 11, 5, 17, okay. You have some good growth potential here, that's good. A debt, you have a low debt. I like this. Margins, okay, they are good. They have good margin and increasing, so this is good. Good return on investment, okay, the efficiency is good with return on equity. It's increasing as well, so except compared to 10 years ago, but generally for the last 5 years it seems to be increasing. We like this, okay. Capital allocation. Capex, okay, is fine. Stock-based compensation is 5. Yeah, like this company seem to be, L'Oréal seem to be to have some good things. Let's have a look at the total revenue. Okay, totally. We'll put in annual. You have a good compounder here, 5.9% per year for the last 30 years. It's a safe growth. It seems to be a safe growth, not a lot of cyclicality, so we like it. That's pretty good. Let's have a look at the EPS. Okay, 7% per year, 9% per year for like 30 years. So they probably do some buybacks. Yeah, 0.34%, 76, 89. So they generally do some buybacks, not a lot, but they do a bit. Probably the margin are getting higher as well. You have operating margin getting higher and higher every year, not by a lot, but a bit higher. So that's good. Okay, we have a good company here. Let's compare with everything. Gross profit, very stable, getting a bit higher. Okay, operating net income margin very stable. Return on equity, it's also pretty good. Yeah, so L'Oréal could be a good defensive business. It can be a good defensive one. When I say defensive, it's like a company that you're pretty much sure that it will grow by 5 to 10% per year for the net income, for the EPS. So I like it. I like it. Okay, need to be bought at a great price. Obviously, you cannot overpay for this, but this can be something interesting in a portfolio. Stellantis. Let's have a look at Stellantis. It's a car dealership, so it's a car constructor and manufacturer, so I know that it will not be something interesting for me. Yeah, for the last 10 years, 3%, last year minus 17. The estimation is 18%. It's pretty good. Okay, 5%. Debt, it would be debt to EBITDA 0.7. They have a low debt compared to other car dealerships. This is pretty good, not dealership, but car manufacturer and so on, car brands. Interest coverage is good. Okay, margins, yes, the margins are way too low. 2%, I think, if you compare to Tesla is 6%. If you compare to Toyota, is also 6 or 8% in operating margin. So margins are way too low. Return on equity, invested capital is way too low. Capex way too high. Maybe it's exceptional. We'll have a look at the capex now. Where is the capex? Let's compare capex to operating cash flow. And you always had a kind of big one. Okay, it's always half of the operating cash flow approximately. So yeah, this is too high of a capex for this company. So yep, if there is some Stellantis fan, I put it in C or D. The reason why maybe it's not a C, it's not a D, it's a C, will be eventually the debt. But the margins are so low, the return on equity and capital are so low that I prefer to put it in D. Evolution AB. Okay, this one has some trouble right now, but let's have a look. Evolution EBIT, companies that grew by 44%. Okay, the expected growth for the next 3 years, 6%, 10%. The EPS grew by 20% last year. The debt, they don't have any debt, so this is good. Margins, operating margin at 67. With the last report is 66%, something like this. So 6% is good. Return on invested capital is pretty good. Okay, it's decreasing over time, but it was so high that it's kind of normal. Okay, same for the margin, they grew. Now they will start decreasing because they are really, really high. Capex to operating cash flow is really low. So it's pretty good. We have some good numbers. You can have a look here. Will not have for 20 years. Yeah, it started in 2012. Great growth here. Net income, great growth as well. Let's have a look at the share outstanding. They did an acquisition here, and then since 2021, just after the acquisition, they bought back 1.7% shares every year. So it's good. Yeah, we have a good business here. Okay, we don't really have a lot of capex. If we compare capex to operating cash flow, it's really good. We don't really have a lot of stock-based compensation as well. So it's a business that I like. Okay, you don't have stock-based compensation at all. So I like this business. For me, I may be biased because it's a company that I have in my portfolio. I put Evolution in S. They don't have debt. They have high growth, high margins. Even if they have a little less growth for the future, they still have great numbers. It's not a company that is at risk to go bankruptcy. They have a solid moat, especially with what's happening now. I think it's something that will increase the moat for the future. So yeah, Evolution, I put it in S. MOWI, I don't know how you pronounce this one. I think it's this one, yeah. What is it? Seafood company produced by farmers salmon. Okay, it's this Norwegian or something like this company that do salmons. It's a fine growth for the last years. Oh, they have big growth estimate. Okay, they plan to grow kind of fast. A low debt, okay. Interest coverage could be better, but all of this is fine. The margins are fine. Let's have a look at how the margin evolved. Operating margins, they evolve kind of fine. Yeah, they're high. It's pretty good. Gross profit is pretty good as well. Let's see if they do some buybacks. They don't seem to do any buybacks. Yeah, over the long run, they even tend to dilute shareholders. Okay, EPS. Do we have any? Yeah, the EPS is very flat. Let's put it on 20 years, 30 years. Can we normalize it? It's pretty flat. This, I don't really like that it's flat. The net income for 30 years, very flat. Okay, so it's strange. I mean, it's not the kind of company that I would like to have in my portfolio. I prefer when it's growing better. This one will go, yep, in C. This one will go in C. It's not terrible business, because they have a low debt level, okay, they have some good margin, good efficiency. It's just that they don't grow, so yeah, I don't really like it. Intuit. This one is an interesting business with a lot of stock-based compensation. You look at it, stock-based compensation is really, really high. Capex is good, the growth, they have a good growth, very stable, okay, they plan to continue to grow, very fine, no debt. This I like, very good. Margins are good. They decreased a bit for the last 5 years, but they are still good. Free cash flow margin are good. Efficiency, it could be higher here, but it's good here and here. Okay, capital allocation, let's have a look. The way the revenue are increasing. Okay, do we have, yeah. This is a very steady growth. We like it, 13% for the last 30 years. Let's have a look how the net income evolved. I guess it will be the same, 19%. So that means that the operating margin have been increasing. Okay, we can see an increase in operating margin. A little decrease since 2020, but then now it starts to increase a little more. They don't seem to do any buybacks. Yeah, they do buybacks. They do a bit of buybacks. Now it's pretty flat. They diluted the shareholder a little, but since 2002, they did some buybacks historically. So it's pretty fine. I will put this one in A because they have low debt, high return. So it's A. It's not S because they really have a high stock-based compensation. But to be honest, I put Intuit between A and S. Exam, I would put it in S because they are definitely better than L'Oreal and Uber. But it's between A and S, okay? SAP, SAP. Okay, SAP, let's see the growth. Okay, we have a stable growth. The EPS planned to grow by 37% per year for the next 4 years, okay. 15, like that's a pretty big growth that is expected. They don't have debt, that's good. Margins are pretty well. Efficiency, it's a bit low, okay. Those returns are a bit low. This one is fine, but this and this, it seems to be a bit low. They don't do stock-based compensation. We'll have a look at this. And the CapEx is fine. Let's have a look at stock-based compensation. Stock-based compensation, it's here, and we'll compare this to the free cash flow. So they just didn't do any for here, but generally, yeah, 1 out of 5. So yeah, the stock-based compensation are a bit high, but it's not too bad. Let's have a look at the growth. Yeah, the growth for the last 30 years, 7%, almost 8% per year. Net income, 8% per year. Let's have a look at the EPS. EPS, 8% per year. And do they do buybacks? They do a little buybacks. Okay, very, very little. So this one I put it in A. Not S because they have some, I think Evolution and Intuit are clearly better. They have higher growth, okay. But SAP is not bad. It's not bad at all. They have good margin. So I put it in A. ServiceNow. What about ServiceNow? Up. Where is it? Here. ServiceNow, how did it grow? Oh, that's a good growth. EPS. We'll have a look at this. It's good plan here. Like the estimates are good. No debt. This is great. Operating margin is a bit low. I don't really like this one. We'll have a look at it. Return on equity capital. It's getting higher and higher. Why did it decrease for 5 years? Capital allocation, stock-based compensation are very high. CapEx, it's at the limit. It's pretty fine. So let's have a look at this. Yeah, the revenue, great compounder. This is really good compounder. Operating income, they became profitable in 2019. Let's have a look. Yeah, in 2019. So yeah, they don't have a big history here. Why did they decrease from year to year? You need to check this if you're interested in this company. I guess they dilute shareholders. Yep. A dilution of shareholders. EPS, so it starts to be up. You need to understand why this is happening. Okay, the cash flow, it will be the same, the free cash flow, I guess. The free cash flow looking way better. Okay, the companies that probably have a lot of investment. The free cash flow is growing really, really good. For the last 5 years, it was what? 23%. 23%. You just had a lot of stock-based compensation. I'm a bit 50% stock-based compensation. It's not really good. ServiceNow, I put it between A and B. Like it can be A. The only thing that I struggle with here will be the net income. Okay, the fact that it's profitable only since 2019 and it was high, then very low, high again. I want to know how they will have with this net income. And same, the cash flow statement with the free cash flow. It's a company that do more free cash flows than net income, okay? So I want to understand why it's this. You need to understand this. So it's between A and B, okay? Let's put it in A because the free cash flow growth is very serious. Now you need to understand a bit more. Like, to be honest, I never studied this business, so I don't know more about it. But in terms of the numbers, it's between here and here. The other problem that I see is that they seem to have low margins or lower return on equity and capital. Yeah, margins are getting higher, but they're not great yet. And in capital efficiency, return on equity is getting higher, and the return on capital employed is getting higher, but it's yet not really good still. So yeah, between A and B, it's too low for me, so I would put it in B. I would put it in B. Let's go with Caterpillar. Caterpillar, we have a growth of, estimate growth is pretty low, okay, but you grew kind of fine for the last 10 years for EPS and free cash flow. 5 years really good. Last year wasn't very good. Let's see. I have a bit of debt, but it's not too bad, okay. Margins operating here, it's growing. Gross profit is growing. Free cash flow is growing. Efficiency is good and growing, okay. CapEx is a bit high. To be honest, the CapEx is a bit high. Let's have a look a bit more here. Let's see if they do some buybacks. They do some buybacks, 2% per year. This is nice. So the EPS probably growing pretty well. The EPS by 94% for the last 5 years. Put it in LTM, 8%. Could be a bit higher, but it's still a good business. Here, oh yeah, this is very cyclical. Okay, it's very cyclical. I don't like this, so it will be a B. It will be a B because it's not a bad business, okay, but it's too cyclical. So I can see that we still have a lot of company. It's already almost 30-minute video. So I will do it in 2 parts. We'll have the part 2 probably in the next day, because after it will be a way too long video and too difficult. So if you have any question, if you have any other things that you want to say that maybe I didn't see about a company, or that there is a company here that you have more information about it, let me know in the comment section. I would be happy to read about it and to learn more about those company, because obviously I cannot know every business in the world. So let me know in the comment section. And in the next day, you will have episode 3, so the second part of this episode coming out.